Yo, what's going on, everyone? It's your boy Traq back with another video. In today's video, we're going to talk about the London session and my strategy that I use to trade the London session. So without further ado, let's get straight into this video. Now, this video is mainly for my scalpers, although swingers and intraday traders could still benefit off of this. So if you are, under one of those three categories, stay for the end of the video. I'm sure you can learn something new because the concepts I teach on the smaller time frames are just as applicable / usable on the higher time frames as well. So let's start off by labeling, or not labeling, but by getting out of the indicator of which indicator I use to label the London session. So the London session indicator is called Sessions, London, New York, and Asia. Just copy paste this into your indicators. Should be right over here. Copy paste that. Here are my settings. I only have London session open because the rest is pretty obvious where is what and what is where. So yeah, so London session is labeled in green. Now, basically what this means is all the price action that's happening within this green zone right here was the price action that happened throughout London session. And then after the green zone, anything that is printed outside of the range of the green zone is price action that happened outside of London session. So for traders who are trading strictly during London, who aren't looking at price action Asia, New York, or all the other sessions, you're strictly focusing on London, then this is generally the time they would come in, which is around I think if you're living in the Eastern time zone like me, you should be around 2. But if you're living somewhere else in the world, God knows where, it would be different for you, and you just want to search it up what time zone that would be, or what time London session would be for you. So first things first is labeling your range. This is the most important part. So before London session even opens, you should have by the way, these are 2 trades we took. We'll go over this later, but you need to have your range ready. So you know where is the range of what price can do, and basically when you're going to start trading and then when you're going to stop trading. That way you can automatically close your trade by the time price reaches this point. Or if the market doesn't even come to or if the market doesn't provide you any opportunities within this open to the close, then you can automatically just stop trading, wait for the next day, and that makes life a lot more simpler and easier. So now that we got that out of the way, let's start off with the price. First of all, let's start off with the trades that I'm going to go over. So the 2 trade setups that I want to go over are GBP USD. As you can see on the chart, we have this on my Discord channel. I sent out this trading view link in the general chat. I said that I'm not taking the setup, because I already promised myself I'm done for the week, but this is looking really good. So we had this nice break of structure, price action, entered this level of demand, and etc. And then we didn't set limits here, but this is the area I would have set limits on if I was looking at the charts at the time. And as you can see, I sent it to the general Discord so everyone could get it. I didn't send it as a signal because, like I said, I was done for the week. I bagged my weekly percentage and I didn't want to go against my trading plan or my word. So yeah, so we didn't take the trade. And then the second one would have been, or is, Euro USD. This trade set up right over here. So we have 2, Euro USD and then GBP USD. We can see these this beautiful setup right here. I was looking to buy at this 5-minute area of demand, and yeah, so let's start off with GBP USD and why I was looking to buy at this point. So to understand the London session, how you want to trade the London session, you need to have the first step mastered. The first step is implementing the higher time frames when it's applicable. So you don't want to use the higher time frames unnecessarily, but you also do not want to not use the higher time frames totally. You want to get a good mix of between the 2. Now you might ask the question, how do you know when to use the higher time frame and when not to use the higher time frame? So this is where I'm going to come in. So before London session comes, you have to ask yourself, what is the trend? What trend am I in? Is the trend down? Is it up? Are we consolidating? What is the trend? Now, the way I usually figure out the trend, especially when I'm scalping or intraday trading, is I go to the 1-hour time frame and I merely just look at the microstructure that's been printed throughout the last few hours. So we start off from this high, which is a high, and then there's a low. From there, we create a lower high, which creates a lower low. And then price action creates once again another lower high. And then right over here, you have your final lower low. And then this would be your lower high, lower low. So we can see that the trend is basically bearish. And initially, we're in a downtrend on the 1-hour time frame. So now we know that London session, until something else happens, until an structure is broken, or overall the market just shifts from bearish to bullish, we're going to be looking for sells generally, because we know the higher time frame direction of the market. So from here, I would go down to the 5-minute or the 15-minute, and I would generally just be waiting for London session to open to see what happens. Now, right now we're not in London session. London session will appear whenever the color changes to green. But right before London session opens, what do we see? We see that the market has shifted from bullish, or from bearish to bullish. So on the 15-minute time frame, we can see in the last London session, the structure was generally bearish. And then once we opened outside of London. This is New York now. Or sorry, this is New York session overlap with London. There is a clean break of structure. So there's a high, there's a low, and then there's a lower high and a lower low. So now that we've broken past this lower high, we can identify that the structure is shifting. Now, what's the first thing you look for after a shift of structure? As in when price is going one specific way and we violate an area of supply, or an area of a lower high where a lower high is printed. The first thing you want to be doing is looking for the expansion move up, right? So the move up that caused that break of structure, basically where the move was birthed, where it was born. And then from there, you want to find the unmitigated institutional candle that resides within this impulsive move. So throughout this impulsive move, there will be institutional candles here, over here, here, and here. Now, your job as a trader is to differentiate from the good institutional candles, the ones that are valid and will give you high probability, and then differentiate from the other ones which are not valid and do not give you high probability. Now, there's a couple of ways to do this. We go over this very well in the mentorship. So if you're interested in that, you could either wait for the next video, or, why wait? Get in the mentorship, save some time, and make your money back like that. So basically, your job now is to figure out where price is going to head next. What area will the market use to later go up? But we know for a fact that the market needs to go down before it goes up. Now, this is where traders get confused. We see that the structure is broken and the market is long-term looking to go higher now. But the one mistake a lot of us traders make, and I used to make this mistake very, very often back in my early stages of transitioning into smart money, is that I would get used to the price action over here. I would allow the price action that's happening right now to manipulate my brain into thinking that this is the trend, that the market is bearish. And even if I do believe that the market is only bearish for a short period of time, I would be looking to short this OB or this OB, thinking that there's a break of structure here so that I could catch a sell to buy. Now, this is done out of you just being impatient. That's a short answer. We got to be realistic. You have to be patient. First of all, this is not done during London, so you're not even supposed to be trading at the time. It's totally fine to look at the charts, but you're not supposed to be trading during the time, which is not in the range from 3 or 2 to, I think it's 8 or 9 for me, which would be, 9, 8 to 9, something like that. So at this point, we're basically just going to find the order block. So now that we've gotten that out of the way, we can move on to finding the OB. So the OB we're going to be watching is this 15-minute institutional candle right over here. Now, this is very self-explanatory on why I'm looking to use this candle. Let me actually just delete all this so that we can have a clean chart. So now I'll go over the confirmations behind why we're going to be using this 15-minute OB. So the first confirmation is during London session, the market was going down. Obviously, we know that the market was down during this London session right over here. Right before the market reversed, right before it had reversed, we've seen that there was this buildup of liquidity of these equal lows. Now, these equal lows were grabbed by this move down, and then there was this move up right here. Now, notice that structure was actually broken before we reversed. So there's a high, there's a low, there's a lower high, and then there's a lower low, and then there's a higher high. So structure was broken right over here. Now, in this case, you might wonder, well, I did what you said, Traq. I found the impulsive move, and then we labeled the institutional candle right here, which was the cause. This OB grabbed liquidity, it broke structure. So there's tons and tons of confirmations to why price may use this OB to hold. Now, sadly, it did not hold. Why? Well, I believe that this is done by the banks to confuse the trader. So they're right on the direction. They're completely right on the direction that the market is going to be heading up, but they are wrong on the timing of when the market will go up. So hence, when they see this OB get violated, they change their bias right away. Now, you don't want to do this. When you see a break of structure and price does not respect the order block, which is at the bottom of the impulsive move that broke structure, remember that this is a sign that the market maker is just manipulating more lows in order to go higher within the next session, or maybe within the next hour or two, whatever it may be. So if that didn't make any sense, just rewatch the video, replay what I just said, and listen to me until it makes sense. So basically this move down was just another manipulation to manipulate this low over here. Why? Well, think about this. Although smart money traders, or it's not although smart money, but although smart money is becoming more famous and popular throughout the days, that doesn't necessarily mean all smart money traders are going to implement the concepts correctly and properly. So there may be a few traders that are looking to go long over here. Now, technically, this is correct. You know, there is a breaker structure and then price comes down. But the problem was the market had used this area of supply to go down. Now, if the market did break past this area of supply, if we broke past this level of supply and we did something like this, then I would probably assume that this demand zone would have held. But because there's a supply zone which gave more momentum to the sellers, we would assume that that's why this demand zone was broken, even though the break of structure was present. Now, don't forget about the break of structure though. The break of structure is your first sign. It's like a hint that the market is going to reverse in the long run, that maybe in the next session we'll see some bullish energy, some bullish momentum. But in the moment, in the time being, this low was manipulated and you could do nothing about it. So if you took a loss, you took a loss. If you didn't, you didn't. Just move on. So now we know why we're using this institutional candle right here, because it's at the bottom of the expansion move up. It's the cause of this impulsive move. We also invalidated, actually I wouldn't say invalidated because we did kind of hold this level of supply, but we did invalidate this lower high right over here. So now that you have your analysis, you've seen that the breakout structure is here, and all you're really waiting for is for the market to come back down into this POI. The next step is to wait for the London session. So now we're going to assume that during London, the market will fall down into here, and then that's your job / Q to look for confirmation on the smaller time frame. So now we're going to play a couple candles out. London session opens, and then boom, the market falls. Now, when London session opens, you do not want to trade right away. It's not like the second we're in London, I'm on the 1 minute time frame, and I'm like, okay, let's find the first breaker structure. Okay, there's a BOS right over here, and then I buy. So there's a problem with this. The reason there's a problem with this is because you have to give time for the session to warm up. The same way when you're a football player, by football I mean European football, like a soccer player, when you get on the pitch, you're not going to start the game right away. You need to train, warm up, and then you kind of get to your potential, and you know for a fact that you're warmed up, you could do the best now. So trading is very similar. London session is similar. We could see that in the beginning, London session is going up, but then it goes down. So the warm up for us is just to see what it's going to do. At the moment, with just one big move like this, we don't really have an idea of what London is going to do next, right? But now that we've seen a big move down like this, we can now anticipate that, okay, London session may be using my higher time frame POI, which was located in last session, and now it may be using this POI to accumulate orders and then go up. So that's simply information that I gathered by waiting it out, just by waiting. So don't get intimidated by the first move or the first move down. Simply stick to your analysis, stick to your ways, and then look for confirmation. So now that we've seen London session has entered our point of interest, the next step is to wait for confirmation on the smaller time frames. Now, confirmation on the smaller time frame is highly subjective. I get a lot of questions asking me, what time frames do you look for confirmation on? Now, I'm going to answer this question once and for all, because I've seen a lot of traders get confused on this. So the answer to this is very simple. Time frames are subjective because if I go to the 15, for example, right over here, right, and I look at lower lows and lower highs, we have a high, we have a low, we have a lower high, and then we have a lower low. If I'm looking to buy, strictly just looking on the 15-minute time frame, I need to see a break of structure above here, because this is the last lower high that brought the market all the way down to my POI. Hence that the range the market is currently trading within is from this high all the way down to this low. And this range was mainly controlled by sellers. So if price is able to break above this range, that's when we can assume that a new range has been created from this low to this high, and the buyers were more in control, which resulted in a break of structure of the bearish range. So that's done on the 15-minute. But now if I go to the 5-minute time frame, same conclusion. There's no order blocks, there's no structure that I can really see. But if I go to the 1-minute time frame now, I can see a different story. I can see that there's a high over here, and then there's a low, and then there's a lower high, and then there's a lower low, and then a lower high and a lower low. Now, some people might say, but Traq, this is just a one candle pullback. is this really structured? Does this count as a BOS? Technically, this is not a break of structure. This is something else, which I explained in the mentorship. We call this a break of supply / demand, but this would be a break of supply. Now, the break of supply is similar to a BOS, although it's not a break of structure. But the effect the break of supply has is the exact same of a break of structure. So if you ever see a level of supply like an order block get broken, let's be logical. Why did that happen? It's because buyers were more strong. The buyers were stronger than the sellers that were holding price from this range all the way down to here. So basically, throughout price action, if we go down to the smaller time frames, everything is a range. Literally every single thing you see is just a range. If I go to the 5-second time frame, right, we could see that from this point on to this point on, sellers were holding very, very strongly, right? But now if I'm able to break above this area where sellers were holding strong, that means that we've created a new range from this point where buyers started to this point where buyers finished off that break of structure or break of supply. So now hopefully that answered your question to what time frames you want to use. As I said, it's subjective. If I go back to the 15-minute, I'd have to wait for a break of structure right over here. But if I go to the 1 minute, I only have to wait for a break of supply right over here. So it's highly subjective. Your job as a trader is to go on the different time frames and test it out, see what looks more cleaner. So now the next step is to wait for a microstructure to shift. Once microstructure has officially shifted your direction that you're wanting price to go. So if on the higher time frame, what is the trend right now? The trend on the higher time frames from a micro perspective is bullish. Right? On a 1 hour or on a 30-minute time frame perspective, we're bullish. But if I go to the 1 minute time frame, we can see that the 1 minute time frame is still bearish. So that means that the microstructure on the 1 minute is bearish, but the microstructure on the 1 hour or the 30-minute is bullish. Hence, we have a contradiction. If macro is one way, but micro is the other way, you do not take a trade, because this equals to a negative correlation, and this is a big contradiction between structure. If both structure, micro and macro, are both together, they're both in line, then that means the higher time frame will produce a big move. But if macro and micro are against each other, like something like this, where micro is bearish but then macro is up, the higher time frame will either consolidate or it's just going to go up, down, up, down, up, down without a confident idea where the price action wants to go. So this is why we always wait for confirmation. Secondly, we also need to confirm that the zone, the London session zone that we found in last London session right over here, is going to hold. So if we don't wait for confirmation, we don't wait for the break of structure or break of supply, then there's no confirmation that this zone is valid and that demand was the demand was produced properly. So let's go back to the highlighter, drop this, boom. So now I know that, so at this point I was merely just waiting for a break of structure, a break of supply right over here. Let's put this out. And it was it here? Yeah, right over here we had that break of supply. Once I saw that break of supply, I automatically knew where the market was heading, right? I automatically knew where the market was heading. Why? Number one, look at London session. London session was extremely bearish from this point on to this point, extremely bearish. If structure shifted after we entered my higher time frame point of interest, what does that lead you to believe? Well, that means that there's only one conclusion. And that conclusion is that our demand zone was correct. And now that's the first thing. Now the second thing, once there's a break of supply, what does that mean? What does a break of supply mean? A break of supply means that there's more buyers willing to buy from this demand zone because price is more discounted, and sellers would be selling. If banks would be selling, if they decided to sell at this point, they wouldn't be getting the best possible price. Hence, they see the value in buying rather than selling. So they broke past all their sell orders. They're going to be breaking past all these sell orders. Another tip that I have for all of you is that when you see a break of structure or a break of supply after price action enters your point of interest, just remember that the move down that led the market into your POI. Remember this very, very critically. I'm going to speak technically, so listen to every single word I say, or else it could lead to disaster. Because if you do this wrong, and you don't implement this properly, you could be involving yourself into bad trades that may lead you to lose money. So the move down, right? Remember the move down that led price action to your POI. The smaller the time frame you go, the more structure you'll see within that move down. Once price action breaks any one of the lower highs within that move down, every single thing above it is up for grabs. It's up for liquidity. So this thing right over here, this area, you could call this a redistribution, a area of supply. This order block right over here, or even the move up that started this move down, it's all up for liquidity now, and the market will break above that range. So now that we've seen that, and we've seen that the price has broken structure right over here, we broken structure. What I did from here is I labeled my institutional candle. Let's go back to the Discord. Right over here, we can see that we perfectly mapped out this OB. I sent this out to the group chat at 4:42 a.m. So this was at 4:42 a.m. You could see right over here, same exact timing. And for all you nerds that want to see the proof that this was not, back tested or whatever, just look at the timing. Yeah, just look at the timing. If that's not enough proof for you, then adios. Adios, my amigo. I have no more time for you. I can't. What else do you want, But anyways, all jokes aside, I'm just messing about. So all jokes aside, this was the POI that we were expecting to hold. Now, let's let a bit more play. And one more tip that I have. When you have your POI, set your limit and go away. What I do is I take the horizontal rate. I set a line right at the open of my entry. And then I also set a line at my stop loss. And then I set a line at where my take profit would be. So my take profit would be right over here. Let me just delete all this because it's getting really ugly. So my take profit would have been right over here. And I just set alerts on every single level. I set one here, I set one here, I set one here. Why? So this way, I don't have to be staring at the chart when the market is over here. Once price action comes to my POI, it'll just give me a next alert on my phone. I'll see that we're triggered. And if the market doesn't even if the market doesn't trigger this point, then I know that I'm probably in profit. And that way, I don't even have to look at the trade. I don't have to look at the chart. I could just sit at home, make food, clean, whatever. You can go do your hobbies, whatever you like to do. But this is a good thing to maintain and tame your mind from going crazy. Also, do not look at the money. When you're in the trade, do not look at the money because the money could trigger. I think the money makes, it reveals our ego. It shows our ego because we see the money. And then after you see the money, let's say it's a good amount of money. It's like a couple $100, which is a lot of money. Even $50 is a lot of money. And then you see that the market is slowly switching structure. Now, your mindset will be really, 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 really biased to the fact that you saw $50 or $100, that you'll start to believe that, nah, this trade might just go up. I just have to trust it. But the structure itself is going against what you said. So therefore, now that you've seen the money, the ego comes in and it's hard for you to believe what is in front of you. And therefore, this is why you should not be looking at the money. A big tip I have. So at this point, we can see that price action, we have our point of interest, and now we just set limits. So let's play this out. Market is doing its thing. Just to hurry this up. And right away, we get triggered in. So right away after you get triggered in, now this is something I noticed that happens a lot in London session. Alhamdulillah. So in London session, at your entry point, you want to see the wicks. You really need to see the wicks. Because these wicks signify that sellers are no longer in control. Because what happened? From this point moving forward, from this point all the way to this point, sellers were in control. Because like I said, even if you have a POI, let's say my POI is right over here. Sellers need to be in control at one point to bring price to your POI, right? Now, after they come into your POI, you have to see the wicks, the consolidation, the change in structure. Because once you start seeing this, it's the first confluence that buyers are actually willing to buy at the level you are looking to buy. And that's a sign that you're getting in with the banks, that you're getting in at the right movement at the right time. So you want to look, you want to look for this small little wick rejection, or it may be big, who knows, but you want to look for that wick rejection. Now we get triggered in, and then right away the market is going. Once we get triggered in, I'm watching structure. I see that we broke supply once again. There's a break of supply, and that means that now the market will probably be heading. Once again, like I said, the second you see the break of supply or the break of structure, that means that the impulsive move down that led the market into your POI, everything above it or below it is up for grabs now. So in this case, since we're looking to buy, once I seen this break of supply, I know for a fact that this is liquidity now. This is liquidity now. This is liquidity now. And the funny thing is, institutional traders, like people who trade smart money, they are looking to sell this, not realizing that since we've already broken structure at the beginning of London session right here, at the beginning of this move up, everything else is up for liquidity now. Because why? Because we're following the higher time frame narrative. The 45-minute time frame narrative is what led us to take the 1 minute sniper entry buy. So now just to prove this, let's see this out. Let's watch this. Boom. Anyone who entered here stopped out. Now we see the second point of interest, which is triggered. So sellers who were looking to sell here, they get their positions triggered. They're happy, trade is going their way. They get more happy, and then what happens? Boom, you get stopped out. Now the next position. So notice how the banks, they're literally the shaitans. It's crazy. They will literally come to your point of interest, trigger you in, make you happy, show you that the trade is going your way to get you comfortable. Because when you're comfortable, what happens? You move your stop to break even, or you add on to positions. If you're not, the best with psychology, you'll add on to positions. And that way, more liquidity is being generated all over the market. All over the market, there's liquidity now. So when the banks see this, they know that there's a higher reward, there's a higher ROI in letting retailers believe that they're right about the move. And then boom, we take them out because they add on to positions, and then money is taken, right? So this point of interest gets triggered. We get a little bit of inducement right here. We actually get triggered, and then the market goes down a bit. So you can see that the inducement on this is absolutely crazy, and price action breaks up once again. Now we have, there's another concept that I want to talk about. It's about discounted and premium. You might be wondering, why did the market use this level of supply and then they bought at such a low price over here? That's going to be held for a completely different video. It's a very, very, very good topic. Amazing concept. You guys should all you guys all need to learn this. It's amazing. And I'll do this in my next video, inshallah. So, I'm not going to talk anymore about that part. We'll leave that for the next video. So price action comes back into this POI after we induce more people to sell. And then the market completely takes off and breaks that level of supply once again, as I stated before. Now, right here, take profit was hit. So not that I took this trade. It was, I didn't really take this trade, as you guys saw in the beginning, because I want to keep it 100% with you. So stop loss was here. But let's just check the RR on this. So this was a 13-to-1 RR, a 4.6 pip stop loss with a 13 or 59. Let's just round this up to 60 because why not? With a 60 pip take profit. That's a 13-to-1 RR, simply done throughout London session. And once again, you would want to get out at this point. So this candle right over here, the last minute of London, the last second of London is when you would have gotten out. So, oh, sorry, no, I made a mistake. Right over here, once price action hits our take profit, we would have been out. But you are still able to trade. Like, you're still allowed to trade until London session closes. And right here is when you call it a day. So this is how easy it is to trade London, just by following structure, order flow, and just following your plan. And then once London session is over, you can just move on with your day. So that's about how long was this? Let's see. This was done throughout the span of, I think that's about 3 hours and 35 minutes. Yeah, 3 hours and 35 minutes. And then the rest of your day, which you got like 8 hours to do anything you want. Just enjoy the rest of your day. And this is done through London. So it's very simple. Usually the London session will provide you 1 to 2 entries per session. At some points, remember, I used the higher time frame in order to get this trade right over here. So if I didn't use the higher time frame, it may have been a bit more confusing. So you have to use the higher time frame with the lower time frame. Now let's move on to Euro USD, which was the second trade I sent out. So one of the brothers in the group chat, they were asking me for my opinion and views on Euro USD. And on Euro USD, we saw price action entered a 1 minute POI. We see a 1 minute BOS and then a continuation of structure. And then I think my point of interest through the 5 minute time frame and sent this out to the brother right here. So before I go to Euro USD, I want you all to see how high GBP USD actually went. So GU took off all the way to around 1.20637, which is a, let's see how much the market moved. So that's a 1.24% increase on GU, which is normal because we all know forex is pretty volatile. But I just felt like stating that. And that's a 29-to-1, 30-to-1, just because, the aesthetics, 30-to-1 is better. I can't even claim 30-to-1. That's way too high. But yeah, 29-to-1, which is very good. Very, very good. So now let's move on to Euro USD. And I'll break down exactly why I was looking to buy right over here. Now, I use the same exact concept for Euro USD as I used for GBP USD. Starting off on the higher time frame. So the higher time frame on the 30-minute, we were pretty bearish. Now, we were very bearish, but if we look towards the left, once again, we can see that the higher time frame, like from a macro perspective, is bullish, right? There's a low, there's a high, there's a higher low, there's a higher high, there's a higher low, and then once again, there's a higher high. So from a viewed out perspective on the 45, we know we're bullish. But if I zoom in and we just look at it like this, then yeah, I'm going to be bearish, correct? So I caught the entry at the very, very bottom. Now, this is how crazy perspective could be. If I was looking at the perspective like this, like the market is going down like this, instead of looking for buys at this point of interest where I found on the 1 minute, what I would have been doing is I would look for a break of structure here, and then I'd be waiting for price to come back down to a point of interest and then go up, right? And as you know, the market closed and I would have missed that entry. It wouldn't have happened. But because of using the higher time frame to my best of abilities, I was able to capture this clean entry right over here. So how did I do this? Don't worry, I'm about to show you right now. So on the 1 hour time frame, we've seen the most recent impulsive move right here, which was continuing the bullish structure. Now from there, I looked for the institutional candle at the very bottom as always, and I just waited for price action to enter that point of interest. Now notice we're not in London session at the moment. All I did was find my POI. Now what I'm doing is I'm waiting for price to enter my POI during London session. During London session, we will enter this POI. Now, I have a theory that sessions are in a line with timing and price. So for example, banks, they have already planned that the market will come down here during London session, because London session is when, the euro is most volatile. The euro currency itself is very volatile during London session. And the market makers know that with that volatility of euro price action, we could take this to the moon, that we could basically double the momentum, double the power of this big move compared to if I just enter this point in Asia. Because if price action entered in Asia, it would have been very, very slow. No volatility would be in the market, and we'd slowly go up. But with the London session volatility and all the liquidity of retailers, the banks are able to push price down and then take it up right away. So this is the 1 hour point of interest that I mapped up, and I simply just waited for price to come down. Now we also had a level of liquidity right here. There is this low and then this low right here. Now this is a double bottom. Although the double bottom is not like straight, it's a bit cranked up. It's a bit what's the word I'm looking for? It's at an angle. So this is called, like, there's not a name for this. You could call this the dynamic double bottom. The dynamic double bottom, because price action tested this trend line once, tested it again, and then it went up. So we know that this is a double bottom, and retailers are looking to buy here as it's a level of support for them in their mindset. So I knew that there's liquidity, and because of that liquidity, London will most likely start off with a move down and then continue with a move up. And that's exactly what happens. London session opens. So let's actually go back in time. Let's go right over here. And London, so let's do a line thing like I did over here. So we're gonna draw a line exactly at 1. So where's 1? All right, it's gonna be at 2, and we're gonna end it at 11. Boom. So this is my range. This is my timings of when I'm gonna be looking for trades. This little gap right over here. Once price action breaks past this black line, I'm out. I'm not gonna be looking for trades anymore. So London session opens, play a candle, and then boom, price goes down. So now that London's open, we can now trade within this range. Now the beauty of this is that I don't really need to look to the left much. I can just use the information that's given to me right over here, right? I can just use all this information to me right over here. And this solves a lot of the problems of looking too far back in time. Focus on the future. ICT, in his videos, I was watching one of his scalping examples a long time ago. Like, this is probably years ago I was watching this. And I noticed that when he trades, he's more focused on what's already happened compared to what's happening in the past, right? And that's a big shout out to him, because I learned that from him. So you guys should be doing the exact same, because new information is much more important than past information. Although you have to know when past information is important and when new information is important. For example, we use past information of this higher time frame POI in order to get an understanding of the new information. So the only reason this new information is important is because I used the past to understand that. And I explained in the beginning that if I didn't have this POI mapped up, I would have been waiting for a break of structure at this point. And when price reached that point, the market had already closed. Or sorry, it wasn't over here. It was like somewhere over here, and the market already closed. So that's why we use higher time frame points of interest. Now from here, I was on the 1 minute time frame, and we're just going to implement the same exact ruling. Price break structure right here, or we break supply. Now every single thing that led price action down to here, every single order block, supply zone, demand zone, whatever it may be, not a demand zone, but a supply zone, everything is up for liquidity. It's up for grabs. So this move that I'm highlighting right here is basically a move which will be 100% filled. And I'll prove this right now. So price action, we didn't quite get an entry right away, although this would have been a beautiful entry. Price action uses this small little point of interest. So now at this point, I'm expecting this high to get broken. If we could break above this high, then that proves my theory that every single thing else that the market created, which led the market down into my POI, is up for liquidity. Now that also means that this low right over here will be the start of a new range. That this is the start of the buy of where buyers were originated, and then this is where, like, you know, the high where buyers were taken over by sellers, and then sellers take over, and then once again buyers take over. It's like it's literally just a game of ranges and ranges and ranges. So let's see what ends up happening. Price action uses POI. And then we get that continuation of structure. Now, I think I was on the 5-minute time frame. Correct, I was. On the 5-minute time frame, I found this institutional candle. Now, we didn't find it right away because I wasn't looking at the chart at the time. We found it around right over here. So this is the 5-minute. We find this order block. It gets a small little wick in it, but I don't believe that that counts as a mitigation. I believe that in order for price to be fully mitigated, the market has to move away from the order block and then come back down. So for short-term traders, I guess someone like ICT, this actually would have been a nice entry for him, because I notice how he usually catches the entry like off of the 1 minute or the second time frame. Or sorry, not the second, the 1 minute time frame, and he catches it in on the very pullback. I'm a bit different. It may be wrong, but it works for me. I believe that this wick does not mitigate the actual order block. Rather, it gives you a probability entry. It gives you a very nice entry, but it does not mitigate it. In order for price to mitigate an OB, we need to give price action the right amount of time to actually pick up all those orders, close their sells to buys, and then take off. Hence, you know, why I had this point of interest mapped up. So this would have been valid for limits. Now, once again, I didn't enter this. I just sent it out. You can see my bro right here said he wanted the lower time frame entry because he was having difficulty picking the confirmation and which order block to use. So I sent him this zone. Although we were expecting another break of structure, this area of supply right here, we didn't get that, but this level was still valid for limits. So from here, limits would have been set, and then play this out. London session triggers them in, and then the market just takes off from here. Now notice how we take off and we fully, like I said before, we want to do a 100% retracement, a 100% mirror of this move, as in we break past the open, and this is where sellers stopped. So we break past the open of where sellers started their move down, and then this is the low where buyers started their move up, and now a new range is created. Once again, a new range is created. So that's exactly how I trade London session. You could do this by yourself. You could do this very, very easily. Backtest it so you know for a fact that it works. If you do have trouble figuring out entries during London, just refer back to this video and watch it very closely, because when you watch something multiple times, it kind of gets engraved into your head. And then you won't really forget it. And then when you look at the charts, you'll be like, oh, I remember this person did it this way, so I know that I have to do it like this. So thank you all so much for watching. I hope this video was fruitful, informational, educational, and it was helpful to you in your trading journey. If you guys have any questions, feel free to leave them in the comment section below. Make sure you follow me on Instagram. I've been a lot more active than normal. I do have a lot of DMs I have to get through. I just had this one phase where I wasn't going through DMs because, you know, I'm sure YouTubers could relate to this, but we get a lot of DMs, like fake proposals, like a bunch of fake DMs by bots, those promotions saying, oh, if you promote this crypto. So I just couldn't be bothered to go through all the DMs because it was hard to figure out who's real and who's fake. But now I'm starting to go through my DMs and reply back to all my fans and all the questions you guys have. So make sure you follow me on Instagram at TraqFX, TraqFX. I will never DM you first, by the way. So if you ever get a DM from an account that seems similar to mine, he has the same logo, similar name like TraqCFX, it's not me. Be very, 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 very safe. You know, let's get these scammers outside of the community. Protect yourself and protect your money. Anyways, guys, once again, I'll see you all in the next video. Peace out and have a good trading week.